The rumor mill has the odds that Energy Transfer Equity, NYSE, ETE, will roll up Energy Transfer Partners, ETP, at nearly 100% in 2019. In fact, ETE was recently upgraded to buy from neutral by BofA Merrill Lynch. BofA states, it has more confidence in consolidation with Energy Transfer Partners, NYSE, ETP, occurring in 2019 given increased clarity from management and an improved leverage outlook. BAML foresees strong performance for ETE and ETP unit holders, as the pro forma entity should trade in line with other large-cap, diversified stocks. The firm estimates a pro forma leverage of 4.4x in its base case, which it says should allow the consolidated company to maintain an investment grade. BAML maintains its buy rating on ETP but trims its price target to $21 from $23. The ETE-ETP consolidation will just be the latest in a long list of MLP roll-ups. Yet, no two roll-ups are created equal. Let me explain. No tax consequence. Many fear the tax consequences of a roll-up. There was a big tax issue with the roll-up of Kinder Morgan, NYSE, KMI, due to KMP unit holders getting hit with taxes. This was due to the fact the surviving entity was structured as a C Corp. ETE and ETP are both MLPs, so this will be a non-taxable event for both unit holder constituencies. This information was first identified by Ray Marola in a recent article. Ray is seeking alpha resident SAW expert on ETP and ETE. The following are excerpts between a street analyst and CFO Mr. Thomas Long on the latest conference call referring to the roll-up question. I was wondering if we can start off with a rating agency question. Clearly, they've been the gating issue on the simplification process. I was just wondering if there's been any conversations about once the projects are fully up and running with Rover and Mariner East 2, will you be able to get trailing credit for the EBITDA that's in service, so that you can simplify earlier? Answer: yes, that is probably one of a very commonly asked question. And absolutely, we continue to have discussions with the rating agencies, but absolutely, answering your question very directly, we do continue to have conversations with the agencies. And we will continue to look at how we can accelerate the process. Further discussion around roll-up entity formation between another analyst and CEO Kelsey Warren, question, and then maybe just the last one as far as the structure and anything new you could say there or refreshes for your thoughts as far as how you see eventual family simplification down the future. And I guess most importantly, do you see a C Corp as something that could really be additive to the family and open up kind of the shareholder base there? Answer: yeah, this is Kelsey. I'll start with the second part of that question. We are evaluating a C Corp structure within our partnership. We are very, very carefully evaluating that. We do not want to do something that is irreversible and something that we would regret. So that is something we are studying. As far as the simplification that you refer to, it would most certainly be a structure whereby ETE acquires ETP. We've looked at every scenario possible to us. And we don't see any mathematical scenario that makes any sense other than that one. Later on the call, there was another analyst exchange with Mr. Warren, question, Kelsey, just back on simplification for a minute. Was it ever in the thought process of consideration, when you're thinking about evaluating a C Corp structure in the family of companies, that you would look at ETP's depreciated asset basis? And from a taxable perspective, obviously any sort of step up with ETP would create a significant amount of tax depreciation that could be amortized for many years. Or is it simply more of a partnership equity-to-equity swap with ETE? And there is no taxable liability coming from that simplification? Answer: both. You are correct. We have looked at just every way we know to look at a C Corp type solution for us. And we've not just said that we will not be doing that. It's just at this time, that does not appear to be the superior solution for us. So we have looked at that, to answer your first part of the question. And of course in the next part of your question, taxes influence our decisions here. They're a very big component for our unit holders to deal with. So that is a reason that we've ended up where we've ended up. I say ended up, that's not fair. Today, if we had to make a decision today, we believe a simple purchase by ETE of ETP would be the structure. That could change by the time the rating agencies give us the green light to go forward. My take: it is obvious to me the management team is letting investors know they're working on a transaction to simplify the corporate structure. CEO Warren stated the deal would most certainly be a structure whereby ETE acquires ETP. Management has looked at every scenario possible, and don't see any mathematical scenario that makes any sense other than that one. Those comments make it abundantly clear that Energy Transfer Equity plans to announce a simplification transaction sooner rather than later. Buying ETE as a twin investment to the current ETP position ensures both positions will benefit equally upon the simplification. We don't have to worry about ETE or ETP getting a better deal. We own both equally. The bottom line is, when Energy Transfer Partners is making money, Energy Transfer Equity is rolling in clover, as Ray Marola puts it. It's a no-brainer to own both ahead of the simplification. Let's take a look at ETE, ETP's long-term prospects. ETE, ETP long-term prospects. ETE, ETP's newly combined assets have created a strong foothold in the most prolific producing basins for the MLP. This should augur organic growth for years to come. See below slide. Source: energytransfer.com. I see ETE, ETP's future growth prospects as rock solid. The MLP has well-positioned assets, strong organic growth prospects, and solid financials. Please review the following key investment highlights slide. Source: energytransfer.com. The following slide depicts the most recent major events for the company. Source: energytransfer.com. The present distribution ratio stands at 1.30x. This significantly lowers the risk to future distributions by providing a substantial cushion. Furthermore, there are several other moves the company can make to increase the coverage ratio at this time. The company's long-term growth prospects are solid. The bottom line: ETE's units are undervalued and oversold at present. ETE has improved YoY/DCF by 83%. Distribution coverage ratio is a strong 1.48x. Even so, we could see more downside if the stock fails to hold this level. Yet, the units are still down significantly from the 2015 highs of $35. I submit the reward outweighs the risk at present. My 12-month price target is $22, which implies 28% upside. Those are my thoughts on the matter. I look forward to reading yours. $16 is major support at present. If you use stop-loss orders, I would set at $16 and my trailing stops if implemented, or 10%. Those are my thoughts on the matter. I look forward to reading yours. Disclosure: we are long ETP, ETE. I wrote this article myself, and it expresses my own opinions. I am not receiving compensation for it, other than from seeking alpha. I have no business relationship with any company whose stock is mentioned in this article.